Hi everyone and welcome. Thank you so much for joining me. If you are a home buyer who is looking to finance their home purchase, this video is 100% for you. Today I have my special guest and good friend Sarah Mars-Batuni from Premier Plus Lending. Sarah, thank you so much for being here with me today.
Thank you for having me.
Of course. And today, take notes because we are going to be talking about the 4 main types of loan programs that are available to you. And the reason why this topic is so important is because today we are going to cut through all of the misinformation that is often so easily found online, and we're going to give you the real nuts and bolts information to help you make an informed decision about your home loan. So without further ado, thank you so much for being here. I'm so excited to have you because you have been an incredible resource to me and to my clients over the years. You've really been their financial loan Sherpa, leading them from just a wish of buying a home to turning that wish into a reality. And I feel like we can talk for literally hours about all of the ins and outs of home financing, but for today's specific video for our viewers, we know most everybody goes online to shop for homes and mortgages first, and there's so much information out there that's not complete and that's oftentimes misleading. Most people probably may not even know that there are 4 different categories of home loans. They just think, oh, a home loan, and that's just one umbrella. So I want to talk about this topic specifically. So tell us, what are these 4 categories of the home loans that are available, generally speaking, and how can we start learning a little bit about each in terms of qualifying criteria that you as a lender would be looking at to help a buyer determine which is the most appropriate home loan for them?
Yeah, first of all, thank you for having me, and you're amazing as well.
Thank you.
Great resource for my clients if they need any real estate assistance. So jump right into the different programs. There's 4 different kinds of categories of programs. We have government loans, which typically includes VA for veterans, or FHA loans, or USDA loans. And then second category of loans is conforming loans, which usually is set by Fannie and Freddie. And then we have jumbo loans, which usually the banks provide. And then the last category of loans would be non-qualified mortgage, and these are all the unique programs. So those are the 4 different categories of loans that we have.
Got it. Okay, so we've got government loans, we've got conforming loans, we have jumbo loans, and we have non-QM. Okay, so 4 main categories. Now, there's also a lot of jargon. There are so many acronyms: FHA, VA, USDA, Fannie Mae, Freddie Mac, DSCR, non-QM, blah, blah, blah. There's just so much out there. Let's make sense of what all this is. And let's go one category at a time. Okay, so let's start now with government loans. You had mentioned VA, USDA, and FHA loans. Now FHA, let's start with that one because that's oftentimes associated with first-time home buyers, right?
Yeah.
Okay.
Which is a huge misconception because anyone who's actually buying a primary residence, they could actually get an FHA loan. So you don't have to be a first-time home buyer to actually get an FHA loan. The great thing about FHA loan, it's only 3.5% down. And the FHA loan limit right now in Los Angeles County, they just raised it recently to $1.149 million. So essentially, you could put 3.5% down and buy over $1 million property with just such a low down payment. And typically, the qualifying categories are a lot easier. You could go as low as 580 on your FICO score.
Okay.
Yeah, which is amazing. Also, your debt-to-income ratio could be significantly higher. They go usually up to 57%. What that means is your expenses compared to your income could be at 57% ratio. So it's a lot easier to qualify for someone who doesn't have the best of credit and who has the lowest down payment.
I think that's amazing because a lot of people, have the misconception of, oh, I need 20% down.
Yeah.
To buy a home, or my credit's not great, I can never qualify for a home mortgage. So as long as it's your primary residence, and again, FHA is not just limited to first-time home buyers, even though that is a common misconception, as long as it's your primary residence and you do have certainly almost all loan programs have certain qualifying criteria. FHA seems to be the one that can really open the most doors to the widest amount of home buyers, first-time buyers or not, as long as it's a primary residence.
Yeah, absolutely.
Awesome.
Absolutely. It's probably one of the most popular programs for first-time home buyers, but again, it's not you're not required to be first-time home buyer to get that loan.
Awesome.
Yeah.
Okay.
And then kind of jumping into the VA loan, which is also amazing for veterans, who deserve this amazing program. You could buy a property for $1.5 million with zero down.
That's amazing.
Yeah. So if you're a veteran out there, don't wait. You don't need any money for down payment to buy a property today. It's an amazing, amazing program for our veterans.
Yeah, that's amazing. And veterans, thank you so much for your service. This is a wonderful loan program. Okay, so in terms of a VA loan, who is responsible to pay for what certain lender fees when it comes to a veteran making a purchase on a home using VA financing? Is seller responsible for certain fees versus the borrower?
Yeah, so the borrower is actually responsible to pay for their own fees, and the seller will pay for their fees. The one thing that's different about VA loans is a termite report is required for all VA loans. So typically the the veteran could pay for the inspection. However, if there's work that needs to be completed, the seller or the buyer could pay for that as well. So that's like the only thing different from a conventional or FHA loan that they do require a termite report.
Yeah, whereas that's not necessary. I mean, it could be up for negotiation and it may not even be required for the type of financing, but for VA it is.
Yes.
Okay, great.
At least in the state of California.
Right, which is where we're based in Los Angeles, so we're talking about what's pertinent to us in our community here. Something that really isn't that pertinent to our community, but we did touch on it as one of the categories of government financing, was you did mention USDA loans. So can you just give us a brief overview on that?
Yeah, so USDA loan, it's basically for farmers, for properties with farmland. And you could do zero down for USDA loans as well. It's just not very common here in Los Angeles.
Yeah, not so much farmland in LA County.
Yes, no.
But it's good to know that people have access to that,
Yeah,
if they go to more rural areas.
Absolutely.
Amazing. So that pretty much covers the government loan category. Okay, so let's move on to the next one. What would you like to talk about next?
So let's talk about conventional loans because that's probably the most popular category of types of loans we do.
Okay.
And conventional conforming loans are provided by Fannie and Freddie. They're the ones who provide financing for it. They each have their own set of guidelines, very similar with few small differences from the other. Like for example, with one example just comes to mind is if you're self-employed with Freddie, if you've been self-employed for 5 years, you only need 1 year tax returns to qualify for the loan. Versus with Fannie, it could be typically it's 2 years unless the findings say otherwise. So the difference is like if you're self-employed, Freddie 1 year, Fannie 2 year tax returns. So small differences, but overall similar requirements. The minimum FICO score requirement for that is 620 versus FHA was 580, so it's a little bit stricter. And the maximum debt to income ratio you could go is 50, meaning your expenses compared to your income cannot exceed 50%.
Got it.
Yeah.
Let's talk really quick about, just as a little important side note, debt to income ratios, because this topic comes into play regardless of what type of loan you're getting, right? So let's talk a little bit, if you can shed some light on what constitutes debt that's being considered in this debt to income ratio. Are we talking like credit card debt, another home loan that you may have, school loans? Lay it on me. What are we looking at?
Yeah, and usually, when I talk to clients, this is the first thing I explain to them is basically the way banks qualify you comes down to your debt to income ratio. And when we talk about expenses, it's typically your mortgage expense, the property you're buying. So it's principal, interest, and then the monthly tax and the monthly insurance. If you're putting less than 20% down, it could also include the mortgage insurance.
Right.
If you're buying a condo, that could also include the HOA. So that's your housing expense. Now, in addition to that, we look at your credit report to see what other expenses are on credit report. And I think the big misconception with debt, we don't look at what's total outstanding debt is. We look at what's the monthly payment associated with that debt. So for example, if you have a $100,000 student loan, I don't care about the $100,000. I just care about what's the monthly payment that you're gonna pay each month. So the monthly expenses from your credit report could be student loan payment, credit card payment, and we combine that with your housing payment. That's considered your total debt in comparison to your income.
The projected housing payment,
Yes.
the house that you're planning on buying.
Exactly.
So you take that hypothetical purchase, you look at the PITI, the principal, interest, taxes, insurance,
Yes.
plus mortgage insurance if less than 20%, plus if there's an HOA fee. So that whole all-in monthly
Exactly.
expense, in addition to your other monthly expenses,
Yes.
come together, and then you compare that total to your monthly income or the
Yeah.
borrower's monthly income.
Yeah,
rather.
absolutely.
Okay.
Absolutely. The things we don't take into consideration that some people may not be aware of is like your utility bills. That's not part of the calculation. Your insurance, like your car insurance or is not part of that calculation.
Okay.
So only things that would be reported on your credit report is what's considered as an expense.
Got it. So like your car, any outstanding credit cards that you
Yes.
have, any other mortgages that you may have, any other liens that you may have. If you have like collections from health insurance or other types of collections, is that taken into
collections-
consideration?
Yeah, so collections would be typically reported on your credit report. You're not required to pay it off to necessarily qualify for the mortgage. If they have a monthly payment associated with it, we'll count that. Sometimes if it's a charge-off type of account, it might no longer have any payment associated, then it's not counted for. So
Okay.
it depends.
Right.
Yeah.
And just talking about this and how unique each of these situations are, I really want to drive the point home that when you are online in the middle of the night shopping for your mortgage, like clicking around, like looking at, ooh, look at this rate, and you start filling out these applications and you get this email saying, congratulations, you're pre-approved. I mean, really, what are they pre-approving you for is such an important question, and how can they really stand by that pre-approval if you haven't fully provided your documentation, and done a complete thorough check about all of the financials. So I'm so glad we're touching on this, because online is always a very convenient place to start, but now talking to you about really the ins and outs of it and how these qualifications become so nuanced based on each individual's circumstances, it's so important to really make sure that the underwriting is really thorough and very customized to each individual borrower.
Yeah, absolutely.
Yeah.
And we're there to find solutions for people. So even if someone doesn't qualify, I will give them the roadmap, what they need to do to get to their goal. So just because someone is not ready today doesn't mean we can't get them ready, in the near future.
Yeah, I love that you brought that up, because as a real estate broker, I tend to start working with home buyers anywhere from 6 months to even a year plus, oftentimes, before they're actually ready to make a purchase. Like most people who like to do their homework, there's this information gathering stage, right? And so you get this idea of, I really want to buy a home. And then you start going online and you're looking at, okay, I need money. How do I get a loan? What do I do? What's the home buying process? And oftentimes people come to me and they say, I kind of don't know where to start. I think I should get pre-approved. And that is actually the very first step that I recommend once I do my initial buyer consultation with a prospective client. One of the first action steps after the consultation is over is talk to Sarah. or talk to your lender, you know, provide the documentation and have that initial review of your paperwork done, because you may have every intention or wish to put an offer on a home in the next 3 months, but your financials will end up saying otherwise. And you have guided several of my clients, like you've looked through their credit reports and said, look, if you pay off this credit card or pay down this credit card, over time your credit score will increase to X, which will enable you to qualify for this kind of a home loan versus that kind of a home loan, which will affect your rate, which ultimately affects affordability, which ultimately affects how much home you can buy. So there are all of these puzzle pieces that come together in this, that, you know, and which is why exactly I said you've been like the home buying Sherpa, you know, on the financing side, because you are leading a lot of these folks who don't exactly know which next step to take in terms of the financing piece. So that's why, like, coming together in this, you know, we make such a great team for the clients to be able to get them from where they are to where they want to be.
Yeah, absolutely.
Have we pretty much exhausted not exhausted, I'm sure we can talk so much more about the conforming loans, but as far as like this general overview for our viewers today, we went through the debt to income, we went through the credit score requirement.
The one thing I was going to mention in regards to credit score, we do offer a soft pull credit. So if someone's not sure about their credit score or they're in the process of paying something off, we could do soft pull credit, which has zero impact on your credit score. And we have a tool that we could run, and that gives you specific instructions which cards to pay off to maximize your FICO score. So you may have, a few different credit cards, but it may be overwhelming to pay it all off at once.
Right.
But this tool gives you specific instructions, like don't pay it off, but pay it down. I've actually seen something that someone had zero balances on all their cards, and by going and charging $10 on one card would improve their score like by 20 points.
Oh my gosh,
so
that's such a huge jump.
Yeah. So it could be as little as that to improve your score from, like a different tier, like a higher tier that could get you a better score.
Right. Amazing. Okay, thank you so much for sharing that. I love that. Okay, so moving on to jumbo financing. Yeah. Okay, let's talk about that. That sounds big.
Yeah. Big. So jumbo loans are basically all loan amounts above the conforming limits. So Fannie and Freddie just came out with the 2024 loan limits, and it's $1.149 for a single family residence. So any loan above that is considered a jumbo loan.
So it's the loan amount.
The loan amount.
Not the purchase price of the home. The loan amount of 1.149. Okay.
Yeah, that's the last year was like $1,089,000. This year is 1,149.
Right.
And typically the financing for jumbo loans are provided by different banks. So all this money we go deposit in our savings, checkings accounts. The banks actually use that to give out jumbo loans. So each bank will set their own guidelines. So for, it depends where you go, will have their own set of rules and guidelines. So there's not like one guideline fit all. So each bank will have their own criteria. But typically speaking, jumbo loans require anywhere from like 10 to 20% down, so you need a higher down payment to qualify. The other thing that's different maybe from FHA to conforming is they also require reserves. So in addition to your down payment, you need to have at least 6 months, sometimes 12 months, sometimes even 24 months in reserves for them to give you a jumbo loan. And the debt to income ratio is also much stricter. It's a hard stop at 45 most banks. Some will make an exception to 50, but again, that's if you have a lot of assets with them. They might, push the limits for you if you have assets. But generally speaking, it's a lot more difficult to qualify for a jumbo loan because it's a higher loan amount.
Got it. You mentioned reserves. Can you touch on that a little bit? You mentioned you may need to have a set number of months of reserves based on your overall financial picture. For reserves, are we talking about savings or assets over, like to be able to cover your monthly expenses?
Exactly.
Okay.
Exactly. So typically, whatever your monthly mortgage is, let's say it's $5,000, they want to see that you have at least 6 months reserves to cover that in case of emergency.
Okay.
Yeah. And again, it depends on your credit profile. Like if your FICO score is lower, that reserve requirement may go up to 12 months instead of 6 months. So it just, and each person is unique, so it's the best thing to do is to just kind of speak to me, and then I could guide them. Yeah.
Got it. You also mentioned that different banks each have their different guidelines. I think it's also important to make a distinction between like banks and direct lenders versus mortgage brokers. So can you touch on that a little bit in terms of the difference between the two and the products that may be different or limited from one bank to another?
So typically with direct lenders, when it comes to jumbo products, it's their only portfolio product. When it comes to like the conforming loan, like we talked about Fannie Freddie, they don't have the choice to they'll combine like typically the strictest version of the two, and they provide one guideline. Versus with the mortgage broker, we just have the option of going with different banks, so we could shop around with different companies for interest rates or different programs depending on what they offer. So you have more options working with the mortgage broker generally than you do with a direct bank. Now, sometimes on a jumbo loan, if you have assets with a specific bank, let's say your checking savings with Bank of America, for example, they may be able to accommodate you based on your assets. So in a case like that, it might be best to go with a direct lender. So I think each case is like unique. The most important step is to talk to your lender, whether it's me or someone else, and they should be able to point you to the right direction.
Awesome. Yeah, I think that's really important. And again, not just to count on the information that you're finding online, because as we're learning, talking to you today, it's really not that cut and dry.
Absolutely not.
Yeah, it's very specific and unique to each individual.
Yes.
Okay. So moving on to non-QM. Let's talk about
My favorite
that.
category.
Favorite category. There's so many little subcategories to this, I think, and so let's just dive right in. Let's talk about non-QM. What does that mean?
So
what is
non-QM stands for non-qualified mortgage. This just means that they don't qualify for your typical mortgage with your tax returns, and we need to find them a different way to qualify these borrowers. Majority of the time, the people who fall in that non-QM category are self-employed borrowers. We love our self-employed borrowers. They make all the money, but you try to write off as much as you can.
Right.
It's the nature of the game,
Yeah.
So sometimes they have the assets, but their taxes reflect otherwise.
Right.
So the most probably common program within that category is our bank statement program. And with the bank statement program, you could either do 12 or 24 months bank statements. So if you have, it could be business bank statements or it could be personal bank statements. So we take the deposits in your bank statements, we add it up, and then we divide it by 12 or 24, and you come up with an average deposit. And typically, depending on your expenses, we can use anywhere from 50 to 75% of those deposits as your source of income in lieu of tax returns.
Got it.
So like a retail store who has a gas station owner who, for example, has a lot of deposits in their account daily, that would be like a typical client for that program.
Got it.
Yeah.
Got it. So you can use either corporate or personal, but not both.
Or both.
Or both.
It
Okay,
could be
good.
both.
It can be both. Okay.
Too. Yeah.
Okay.
It depends what their deposit structure is. You know what I mean? Some people who are like a sole proprietor, they may not have a corporate account and
Sure.
they use their personal account. So then we can use personal. Some people have both, so it just depends. And some people have multiple businesses, so we could combine bank statements from both businesses.
Oh, got it. That's great.
Yeah.
Okay, wonderful. And what is another one of these subcategories?
Yeah, the next probably most popular one is, we call it the profit and loss program. And this is like probably types of businesses who don't necessarily have regular deposits. They may work on one big project and get like a huge lump sum. And when I look at bank statements, there's no consistent deposit. So going bank statement may not be the best route, but doing profit and loss, which needs to be prepared by your accountant. So they provide a profit and loss for 12 months. And then that's what's used in lieu of tax returns again.
So just a 12-month profit and loss
Yes.
period.
Yeah.
Okay.
You do need 20% down, just to clarify
Okay.
the down
Yeah,
payment.
let's talk about that.
So down payment needs to be 20% with profit and loss, and with the bank statement you could do as low as 10%.
Got it.
Yeah.
Got it. So it's sounding like one of the most significant differences between non-QM loans and all the other categories is that whereas for the first three that we were discussing, tax returns are
Yeah.
needed, whether 1 year or 2 years of tax returns. For non-QM, you have a lot more flexibility in terms
Absolutely.
of not needing to provide tax returns. So, because I know, a lot of people are like, well, I started my own business, or I'm a sole proprietor, or I'm self-employed. I don't get paid every 2 weeks. Can I afford to buy a home? Can I qualify for a home loan? So having this option or these
Yeah.
various options is really fantastic. It opens the doors to being able to qualify
Yeah,
for a home.
honestly, I always say if there is a way.
Yes.
I'll find a way.
You will find a way. I have given you some really hard. I've given you some really hard loans to do. I remember the first loan that I gave you was one that the borrower had talked to a few different lenders, and nobody was able, given this person's pay structure, to qualify them for a loan. And that's how we started working together, actually,
Yeah.
because you really pulled through for this particular borrower, and I got to congratulate them on closing escrow on their home, and they were so happy. And it's just
Yeah.
because you were able to really think outside of the box and make things happen.
Yeah,
For
thank
them.
you.
Yeah.
Thank you.
Yeah.
I'm so glad that worked out. And
Me too. Yeah, we both know who we're talking about. Yeah,
Yeah.
yeah,
Yeah.
they're thrilled.
And
yeah.
then just to add like a couple of different programs under that non-QM category,
Mm-hmm.
we have foreign nationals. So someone who lives in a different country but wants to buy a property here in the United States, we have a foreign national program. A couple of other ones is ITIN loan. So someone who does live here in U.S., they may be a non-permanent resident. They don't have a social security, but they have a tax ID number. We could use that to qualify. And the last one, that's actually, I should say there's like a few other ones, but
There's so
I
many.
could go on and on. No, DSCR is typically for an investor who we don't require any income documents. It's the rental income from the property is used to offset your mortgage, so a rental income from the subject property is used to qualify.
DSCR, that's debt service coverage ratio, is what that
Exactly.
stands for, right?
Yeah,
Okay.
yeah. And then I've done another type of transaction where the client was, for example, retired. They had a lot of money in their retirement account, like an IRA 401k, and they didn't want to liquidate and buy the property cash, even though they could. There was a lot of tax implications if they did that. We ended up using their assets as a source of income. So it's called
amazing.
the asset depletion loan. Yeah, so
That's great. Yeah, because a lot of people, if you don't have employment, if you don't have income coming in, for most
Yeah.
people, that is going to be a roadblock
yeah,
to getting financing.
yeah.
But
So-
in this case, there is a way to work around that if there are sufficient assets
Yes,
in a retirement
absolutely.
account. Awesome. One thing we didn't really touch on yet that I think it's worth talking about is hard money
Yes.
financing. Let's talk about that. Give us your rundown of hard money. When would somebody opt for hard money financing? We've seen it used more for short-term financing, not like your long-term purchase. like your permanent financing. So can you touch on hard money loans for a bit?
Absolutely. So typically hard money comes from a private institution. It's not a bank or anything like that. It ultimately comes down to the property. They don't check income or anything like that. So if the property and the value of the property is there, and the individual's putting enough down payment, so you do need like 25 to 30% down for a private loan. And because the cost is high and the rate is so high, it's typically worth taking this loan if you're flipping a property, meaning you're going to buy, fix it, sell it. So it's a short-term loan. Most of them are 12-month terms. So if you're going to buy, fix, and sell, this could be a great way to get a loan very quickly. They take about a week to get. It's very easy process. All you need is some money for a down payment.
Right. Got it. Yeah, I've even seen in very competitive situations, some people just opt to get hard money financing, knowing that they will be putting permanent financing on the home in a short period of time shortly after closing.
Or the other thing that's worth mentioning, Christina, is if you find a property that's a total fixer, that has like an empty pool, or the property is just not in a livable condition, where a traditional bank would not lend you money on a property like that, you could get a hard money loan, short term, fix it up very quickly, and then turn around and get like a regular long-term 30-year fix once the property's fixed.
Amazing. Yeah, so that definitely gives you options to be able to put financing on a property that would otherwise not be traditionally financeable.
Yeah, okay. Absolutely.
I feel like we've gotten a really good overview from you on these 4 different loan categories. Is there anything that we missed, like without really doing a deep dive into any one category?
No.
Any sort of like parting thoughts that you'd like to share?
The one program I was going to mention, it's a home equity line of credit.
Yes. Okay.
Which is a secondary mortgage on your existing property. We have the highest equity. Most people who own a home, they have the highest equity now than ever before. Historically, and I saw statistics that like 30% of people own their property free and clear. And a lot of people are locked into their super low interest rates, but they want to make a move, they want to upgrade. So my recommendation is take a home equity line of credit on your existing property, use that as a down payment to level up, go next level, and then when the rates come down, all we have to do is refinance. Take advantage of a home equity line of credit.
Right. Yeah, it could essentially, like free up funds for you to go buy an investment, put your money to work for you, buy that other home if you need more space, whatever the case may be. I think that's awesome. Thank you so much for bringing that up. As you all can see, there is so much information that we tapped into, and we've really just barely scratched the surface, I feel, in terms of all these different types of loan programs. The biggest takeaway that I would love for all of you to have is that you have options. Don't necessarily just go online, do some research, and think that what you found on the internet is going to give you all the answers that you need. Buying a home, or any kind of property for that matter, is a very individual, unique journey, and you really deserve to give yourself the time and the resources and surround yourself with the experts who can look at your specific financial situation and give you proper guidance based on your individual circumstances, not just some cookie cutter, blanket solution that, the person who issued that on the, other end of the monitor may not be able to stand behind. So I hope you derived some immense value today. If you have any questions about home loans or real estate, please feel free to reach out. We are here for you to be valuable resources. And I want to thank you for tuning in. And Sarah, thank you so much. I can't tell you how grateful I am that you are part of my team, and you've been just such a valuable resource to my clients to help them realize their goals of homeownership. So thank you. I'm looking forward to our next video. I know we have a lot to talk about, so we'll be doing more of these. And thank you so much again. Until next time, take care.